Yesterday we celebrated. We told the world the banks had finally bowed. We told you the era of price suppression was finished. But today the lines went silent. The spot price of silver is sitting at 64. It was held. It didn't give back an inch. On paper, you are wealthier than ever. Now try to use it. Try to walk into the physical market and turn that 6230 into a single ounce of real metal. Go ahead. Call the biggest wholesalers in North America. Call the refiners in Switzerland. Call the mints in Australia. What will you hear? A deadline or a recorded message. Due to extreme market volatility, we are not accepting new orders. We warned you this moment wouldn't feel like a victory lap. We told you that once the price finally tore through the commercial ceiling, the ascent wouldn't be smooth. It would crack the system itself. And now it has. What you're watching at 6230 isn't a supply shortage. It's a full-scale liquidity failure. The physical pipeline has snapped. Refineries are stopping purchases. Wholesalers are canceling trades they confirmed yesterday. The US Mint is reportedly sliding into indefinite allocation. Why? Because the price moved too far too fast. It sounds absurd. High prices should unlock supply. That's economics 101. High prices attract sellers. But silver doesn't follow 101. Silver is a leverage-built tower. And at 64, the hedging mechanism that keeps refineries alive has turned into a trapdoor. In this video, and this may be the most serious alert I've ever issued, I'm going to show you why the supply chain has frozen. I'm going to walk you through the refiner's bind. I'm going to explain why holding fiat right now may be the riskiest position of all. And I'm going to show you why 64 isn't a price. It's a coordinate, the last ping from a ship that just slipped off radar. If you're still waiting for a pullback, you're already underwater. The window didn't close. It was sealed shut. This is the nightmare scenario. The replacement risk that broke the market. Let's pin down the situation on the ground as of December 11th. In a normal market, you have two sides: the bid, what buyers are willing to pay, and the ask, what sellers are willing to accept. When those two meet, a trade happens. That's liquidity. But this morning, the silver market stopped behaving like a market at all. It has become bid only. Millions of buyers are waving cash at $62, $65, even $70 an ounce. And yet there is no counterparty. The sellers have vanished. I got a call from a major contact at one of the largest precious metals distributors in Texas, a firm that normally moves millions of ounces every month. His message was blunt. We have stopped all sales. Our hedging line with the bullion bank is maxed out. We can't replace the metal we sell, so we're shutting the website until further notice. Think about that. Their entire business is selling silver. Silver is at an all-time high, and they are refusing to sell a single ounce. Why? Replacement risk. Put yourself in the dealer's position. You're holding a monster box of Silver Eagles you bought 3 months ago at $30 an ounce. Today, the spot price is 64. It looks like an easy profit, right? Wrong. Because the moment you sell that box at 62 an ounce, you're holding cash. And if silver jumps to 70, 80, or 100, before you can restock, you're wiped out. You sold an appreciating asset for a currency that's losing purchasing power by the hour. The experienced dealers, the ones who lived through 1980 and 2011, recognize the trap immediately. They're not selling. They're hoarding their own inventory, betting that the metal is worth far more than the spread. This creates a liquidity vacuum. The metal exists. It's sitting in vaults and safes, but it's no longer available. Inventory has turned into a strategic reserve, and the impact is now hitting you directly. Check APMEX GM Bullion or SD Bullion right now. You'll see pre-order buttons. Estimated shipping February 2026. Those aren't orders, they are unsecured loans to a dealer who doesn't have the metal in hand. At 6230, the physical link has snapped, and the break begins at the top of the chain, the refineries. This is the technical part, and you must understand it to understand why 6230 shattered the system. Most people think refineries like Harius Pamp or Valcambi behave like speculators cheering high prices. They don't. Refiners fear volatility more than anything. Here's how their world works. A refinery buys raw door bars from a mine, say 1 million ounces. Refining takes time, 2 weeks, maybe a month. During that period, the refinery is terrified the price will fall. If they buy at 62 and the market drops to 50, they lose millions. So they hedge. The moment they purchase that physical metal, they short an equivalent amount on the futures exchange. 1 million ounces in hand, 1 million ounces sold short, a perfect hedge. If the price drops, their physical inventory loses value, but their short position gains. If price rises, their physical gains and the short loses. Net zero, they just earn the refining fee. This system works smoothly when silver moves 10 cents a day. It survives 50-cent swings. But what happens when silver jumps 250 in a single day and several dollars more the next morning? The margin call. The refinery is holding the physical metal, but that metal is locked in a furnace, not sitting as cash. Meanwhile, the short position is hemorrhaging money with every tick higher. As the price rips towards 62.30, the exchange demands cash, real dollars, to cover the loss on the paper side. The refinery might be solvent, but it is instantly illiquid. The exchange doesn't care that they have metal, they want cash now. And that is where the nightmare begins. When margin calls paralyzed the global silver industry, the refinery may still be solvent on paper, but it is completely illiquid. So when silver blasted through $60 on Wednesday, December 10th, every major refinery on the planet got the same call from its broker: wire $50 million now, or we liquidate your position. Where does a refinery find $50 million in cash overnight? It doesn't. Because it can't, it freezes. The first thing to go is purchasing. They stop buying raw ore from the mines because they can no longer afford to put on the hedge required to process that ore. And when ore stops coming in refined bars, stop going out. This is the moment the supply chain seized up. The price spike didn't just strain the system, it detonated the hedging mechanism that keeps the system functioning. It is a paradox: the higher the price climbs, the less silver gets produced. We saw hints of this in March 2020 and again in February 2021. But those episodes were mild tremors. Back then, silver was $12. At 62.30, the capital demands are 5 times larger, and the margin calls are 5 times more punishing. The refineries are frozen in place. Until volatility dies down, until the price stabilizes, they will not produce a single new bar. We are staring at a global production freeze at the same moment demand is erupting. And when the refineries lock up, the next layer collapses with them, the wholesalers. These are the companies that buy 1,000-ounce industrial bars and convert them into 1-ounce rounds, 10-ounce bars, and coins the bridge between the industrial market and you, the retail buyer. When refiners stopped taking orders this morning, wholesalers panicked. A source at a major minting facility in Florida told me just 2 hours ago that the atmosphere there feels apocalyptic. His words: "We have orders for 500,000 ounces from yesterday's breakout. We took the cash, but our supplier canceled next week's delivery. We're now short 500,000 ounces. If we can't find metal, we're technically bankrupt." Here's the uncomfortable truth about the bullion world: most of it runs on just-in-time inventory. When you buy from a website, the dealer often does not have that exact bar in stock. They order it from the wholesaler who orders from the refiner. Break one link and the entire chain fails. The Florida Mint now faces 2 choices. Option 1, refund your money, handing you back fiat that is falling in real value. Option 2, delay your order and send the dreaded allocation email. Today we are seeing option 2 everywhere. Check your inbox and you may find, due to unprecedented demand, your order has been delayed. Estimated shipping 4 to 6 weeks. Translation: we don't have the silver. We're hoping the price drops or the refinery restarts. But here's the twist. While wholesalers scramble, industrial giants are moving aggressively. Tesla, Samsung, First Solar, they are not buying 1-ounce coins. They buy 1,000-ounce bars directly from the vaults. And at 62.30, they're not hedging, they're stockpiling. They understand the mechanics you just learned. They know that if refineries stay offline for a month, solar production lines halt, and that is non-negotiable. So they bypass the wholesalers entirely. They offer premiums no coin shop can match: $65, $70, even $75 an ounce for immediate delivery of industrial bars. This vacuum cleans the last pockets of liquidity out of the retail market. The wholesalers are being outbid by the tech titans, and you as a retail buyer are competing with Elon Musk. Who do you think wins that auction? This contagion is accelerating. By next week, 80% of the online inventory you see today could be marked sold out. The remaining 20% may carry premiums of 50% or more. Spot may sit at 62, while Silver Eagles touch $100. That isn't exaggeration, that is what a broken supply chain looks like when price discovery disconnects from physical flow. Force majeure, the escape hatch of a failing system. Now we need to confront the legal consequences. The term you must understand today is force majeure, a French phrase meaning superior force. In contract law, it's the clause that lets a company walk away from obligations when an unforeseeable event makes performance impossible. Traditionally, this applied to wars, earthquakes, and acts of God. But buried in the fine print of nearly every bullion dealer and futures exchange is a modern twist market dislocation, or extreme volatility also qualifies as force majeure. And with silver at 62.30 and refineries frozen, we are standing dangerously close to that trigger point. What does that mean for you if you hold unallocated silver in a pool account? If you hold SLV shares? If you hold a futures contract and the issuing entity declares force majeure, they no longer owe you metal. They are allowed to settle in cash at a price they choose, not the market price. Picture this: silver hits $100 next week. Your dealer or bank declares force majeure because they can't source the metal. They mail you a check based on the December 10th closing price of $61.75. Meanwhile, the live price is $100. You lose $40 an ounce and you lose the metal entirely. And all of it is perfectly legal. This is why I've repeated the same warning for years. If you don't hold it, you don't own it. At 62.30, counterparty risk is no longer abstract. It is the dominant threat. The system is searching for an escape hatch, and force majeure is that hatch. We are already seeing the early tremors. The Shanghai Gold Exchange just raised margin requirements to 20%. COMEX is expected to raise margins tonight. Those are soft barriers. Force majeure is the hard one. If refineries stay offline for another week, if margin calls go unfilled, the first domino will fall. Maybe a small mint, maybe a regional bank. But once the chain starts, the wave of cash-only settlements begins. You do not want to be a creditor in that environment. You want to be the holder of the physical asset. And this leads us into the new reality, the divorce of spot and physical. For 40 years, their relationship was stable. They moved together sometimes with a premium of $2 or $3, but always in tandem. At 62.30, that marriage is over. Spot is becoming irrelevant, a digital number representing a 5,000-ounce bar that may or may not exist, traded by high-frequency algorithms. The real price is what you can negotiate in the physical world, what the solar manufacturer pays a refiner, what your local coin shop charges you. Right now, that number is closer to $80. If spot says 62 but you cannot buy below 80, then the real price is 80. The screen is lying. This divergence is dangerous because it tricks you. You see spot fall to 61 or 50 and think, I'll wait to buy. But the physical premium just climbed by $2 more. The cost of actual metal went up even as the chart went down. This is called backwardation, when immediate possession of an asset becomes far more valuable than the promise of future delivery. Why is it happening? Because trust has evaporated. No one trusts COMEX to deliver. No one trusts refineries to reopen quickly. No one trusts the dollar to hold value. When trust collapses, premiums explode. We've seen this in Venezuela and Zimbabwe. When a currency enters crisis, gold and silver don't simply rise, they vanish from official markets and retreat into the black market. We're not fully there yet, but halted refinery orders are step one. The official channels are clogging. The unofficial channels are absorbing the flow. If you're still staring at the CNBC ticker, you're watching a ghost. For those just joining, let me restate what we proved in part 1. The mechanism of the silver market has failed. Refineries have halted orders because their hedging structures collapsed. Wholesalers are canceling deliveries because they cannot obtain metal. And the spot price of 62.30 is rapidly becoming a phantom number. We have crossed the event horizon. In astrophysics, that's the point where gravity becomes so strong, not even light can escape. Once crossed, you cannot turn back. You cannot reverse course. You are inside the gravity well. The silver market crossed its event horizon at 9:06 a.m., when the major Swiss refineries stopped answering their phones. So what comes next? If you thought the last 24 hours were extreme, you haven't seen anything yet. The next phase is the unobtanium phase. Over the next minutes, I'm going to map out where this crisis heads. I'm going to detail the small pivot that could inflate the biggest equity bubble since the dot-com era. I'm going to outline the regulatory response, the hammer that will fall when policymakers try to contain this. And most importantly, I'm going to give you the roadmap to $100, not as a theory, but as a mathematical consequence of the structural failure unfolding in real time. Buckle up, the easy part is over, the grind begins now. The rise of unobtanium, when industry enters survival mode. To understand where silver goes from 62.30, you must stop thinking like a trader. You have to think like a survivalist. You have to understand the psychology of unobtanium, a term from engineering and sci-fi describing a material that is perfect for its purpose, but impossible to acquire. When a commodity becomes unobtanium, the price doesn't rise by 10% a day. It hits a vertical wall, it doubles, then it doubles again. We've seen this before. In 2020, rhodium essential for catalytic converters experienced a supply squeeze. Manufacturers panicked. The price rocketed from $2,000 to $29,000, a 14 times surge. Why? Because without rhodium, automakers couldn't sell a $50,000 car. Paying $29,000 for an ounce of powder was cheap, compared to shutting down an entire factory. Silver has now entered that same phase. Think about the solar industry. A TOPCon solar panel facility runs around the clock. It costs billions to build, employs thousands of workers, and carries government contracts to deliver gigawatts of power. If silver paste runs out, the factory stops. Workers go home, contracts break, the stock collapses, regulators come knocking. So what is the procurement manager at First Solar doing right now? He's staring at the chart, he sees 6230, he calls his supplier. The supplier says, no inventory. Does he shrug and wait? No. He panics. He shouts, I don't care what the price is, find it. He calls competitors. He calls a vault in London. He calls a private hoarder. He offers 70. Rejected. He offers 80. Rejected. He offers 100, and finally someone says yes. That is how the price leaps from 62 to 100 overnight. Not speculation, existential panic. Retail investors like us feel FOMO, fear of missing out. Industrial users feel photo, fear of dying out. Photo is infinitely stronger than FOMO. Today we're already seeing reports that Samsung and LG are approaching mining companies directly attempting to buy run-of-mine production. They're sidestepping the refineries entirely. They're offering to finance mines in exchange for guaranteed delivery. This is the purest signal of unobtanium. The supply chain is being rewritten in real time. During this phase, price becomes inelastic. No matter how high it goes, the buying continues. Normally, high prices kill high prices because demand cools. But you cannot stop buying the material that keeps your industry or your civilization running. At 6230, we are only at the bottom of the unobtanium curve. The true panic hasn't even begun. Wait until Apple delays iPhone production because of silver shortages. Wait until the US military invokes the Defense Production Act to secure silver for missile systems. Then you will understand what real mania looks like. Now let's talk about the second wave of this wealth transfer. If you can't buy physical because refineries are frozen, and you can't buy futures because the margins are unbearable, where does the capital go? It flows to the source, the miners. For a decade, silver miners have been the most unloved sector on Wall Street. Underfunded, shorted, ignored. Some traded for less than the cash on their balance sheet. But at 6230 silver, their economics have transformed into a lottery ticket. Let's run the math. Take a hypothetical miner, Apex Silver. Their all-in sustaining cost is $20 per ounce. At the old price of $25, they earned $5 per ounce, barely keeping the lights on. But at 6230, their cost is still $20. Their profit is now $42.30 per ounce, an 800% explosion in free cash flow. Has their stock risen 800% numbers? Because the market is slow. The market is skeptical. The market waits for earnings. But when Apex reports that Q4 2025 profits exceed their previous 10 years combined, that chart becomes a vertical line. Here's the twist: the refinery halt actually benefits the miners. With refineries unable to hedge, miners holding ore become the new strategic reserve. Industrial buyers, Tesla, Samsung, will approach them directly. They'll buy half the mine, or the entire mine. We're on the edge of an acquisition frenzy: tech companies buying miners, auto companies buying miners, sovereign wealth funds buying miners. A capital flood like this ignites a mining supercycle. If you miss the physical boat, if you're sitting on cash and can't buy coins, the miners are the lifeboat. But here's the warning: not all miners are equal. Some hedged their production last year at $30 an ounce. They're finished, they don't participate in the rally. You must find the unhedged miners, the ones whose earnings float with spot. And you must consider jurisdiction risk. Remember, Mexico is the world's largest silver producer. At 6230, do you think the Mexican government will let foreign shareholders pocket all the profit? Of course not. Rumors of windfall taxes in Mexico and Peru are already circulating. Nationalization is the next step. That's why miners in Canada, the US, and Australia will trade at massive premiums. The miner pivot has begun. Smart money is leaving bullion dealers who have no stock and moving to mining exchanges which still have liquidity. This is where the next 10x wave is forming. And now we need to have a very serious conversation about the empire striking back. Don't think for a moment that JP Morgan or the Federal Reserve will allow silver to hit 100 without resistance. They've lost the market war. Next comes the regulatory war. We've seen this playbook before. In 1980, during the Hunt Brothers episode, COMEX changed the rules overnight. They imposed liquidation-only orders. They made it illegal to buy, you could only sell. They raised margin requirements to 100%. We are likely days away from seeing that script again. The minor pivot, where the next 10x is born. Now let's talk about the second wave of this wealth transfer. If you can't buy physical silver because the refineries are frozen, and you can't buy futures because the margins are insane, where does the money go? It goes to the source, the miners. For 10 years, silver miners have been the most hated corner of Wall Street. They've been starved of capital shorted by the banks and traded at valuations that made no sense. You could buy an entire silver miner for less than the cash they held in the bank. But at 62.30 silver, the economics of mining have just turned into a lottery ticket. Let's run the numbers on a hypothetical producer, call it Apex Silver. Apex has an all-in sustaining cost of $20 an ounce, fuel, labor, exploration, taxes, everything. At $25 silver, the old world Apex made $5 per ounce. It was a miserable business. They barely kept the lights on. But at 62.30, their cost is still around $20. Their profit is now $42.30 per ounce. That's an 800% explosion in free cash flow. Has their stock gone up 800%? Yet number E. Because the market is slow. The market is skeptical. The market still doesn't believe this price is real. But when the quarterly earnings drop, when Apex announces they made more money in Q4 2025 than in the last 10 years combined, that stock chart will turn into a vertical line. And here's the twist, the refinery halt actually helps the miners. Why? Because the miners sit on the ore. If refiners can't hedge, miners become the new strategic reserve. Industrial buyers. Tesla Samsung will come directly to Apex Silver. They'll buy 50% of the mine, or they'll buy the whole thing. We are on the edge of a mergers and acquisitions mania. Tech companies, buying mining companies, auto companies, buying mining companies, sovereign wealth funds, buying mining companies. That capital flood creates a super cycle in mining stocks. If you miss the physical boat, if you're sitting on cash and can't find coins, the miners are the lifeboat. But here's a serious warning, you cannot just buy anything with silver in the name. Not all miners are equal. Some hedged their production last year at $30. They're trapped. They don't participate in this rally. You have to find the unhedged miners, the ones fully exposed to the spot price. You also have to think about jurisdiction risk. Remember Mexico, the world's largest producer, at 62.30 silver. Do you really believe the Mexican government will sit back and let foreign shareholders keep every extra dollar of profit? No. We're already hearing rumors of windfall profit taxes in Mexico and Peru. Nationalization is the logical next step, which is why miners in safer jurisdictions, Canada, the US, Australia, will trade at huge premiums. The miner pivot has begun. Smart money is leaving bullion dealers with empty shelves and moving to the mining exchanges where liquidity still exists. This is where the next 10 times move is likely to appear. Now we have to talk about the empire striking back. Do not assume for 1 second that the JP Morgans and the Federal Reserves of the world are just going to roll over and die. They will not let silver march to 100 without a fight. They have lost the market war, so now they will launch the regulatory war. We've seen this movie before. In 1980, during the Hunt brothers saga, COMEX changed the rules overnight. They imposed liquidation-only orders. They made it illegal to buy. You could only sell. They jacked margin requirements to 100%. We are likely days away from a similar script at 62.30. Here's the playbook they'll use to try to break the price. Tactic 1, the margin nuke. CME will announce an emergency hike in margin requirements. Maybe today it costs $10,000 to control a contract. They'll push that to $50,000 or $100,000. The goal is simple: force out small speculators and retail traders. Force you to sell because you can't post the collateral. Tactic 2, position limits. The CFTC will declare a market emergency. They'll claim speculators are distorting the price and cap how many contracts any entity can hold. And here's the ugly part, they will likely exempt commercial hedgers, the banks. The banks can stay short while you are forced to cut your longs. The game is rigged. Tactic 3, the windfall tax threat. Politicians will go on television and accuse hoarders of holding the green transition hostage. They'll brand silver stackers as economic terrorists or price gougers. They'll float new taxes on precious metal sales. They're not trying to solve a problem, they're trying to scare you into selling. Tactic 4, ETF cash settlement. Remember force majeure. Watch SLV, the iShares Silver Trust. They could quietly amend their prospectus. Overnight, they might say, in the interest of fund stability, we are suspending the creation of new baskets. That breaks the link between the ETF and physical metal. SLV might trade at 50 while spot trades at 70. Passive investors get trapped inside paper. You have to be ready for those headlines. When they hit, price can lurch lower. Silver can drop from 60 to 55 in an hour on nothing but news. The media will rush in. The bubble has burst. The government has stepped in. Do not be fooled. Regulations cannot print silver. Margin hikes cannot create silver. Taxes cannot manufacture silver. All these tactics can do is crush paper demand. They do nothing to fix the physical shortage. In fact, they make it worse. Tax it, and people hide it. Ban speculation and price discovery moves to the black market. The price of silver is no longer set by the CFTC. It's set by the physical deficit. Unless a government can conjure 1.1 billion ounces out of thin air, they are powerless. They can generate volatility. They cannot change the trend. So when the regulatory hammer comes down, and it will come down, recognize it for what it is: a sign of desperation, the final groan of a system that has already failed. In the weeks ahead, the noise will get louder. Headlines will swing from panic to denial. Experts will argue about models they no longer control. But underneath that chaos, one truth remains steady. Real value survives. Real assets endure. And the people who prepare early are the ones who stay upright when the ground shifts. So stay observant, stay disciplined, and stay focused on purchasing power, not promises. We'll track every development as it unfolds clearly, calmly, and without fear. For now, hold steady. A very different financial landscape is taking shape.